Now, on to today's market movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Urio. Today we're talking about a potential crisis in Italy that's taken their 2-year yield from 0.75 to 1.44 in 3 days. We're looking at using Euro currency options 6E to either hedge risk or create opportunities for further EU stress. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim. I missed you.
Okay, thank you. And the move in the euro has been relatively significant, but it doesn't seem to coincide with that move in Italian bonds. It started at the exact same time. It has to be attributed to that in my mind, but it's not as dramatic. Is the euro market wrong?
Well, what happens in your mind is my reality,
Exactly.
by the way. But I think what's interesting, you're right. The euro has moved, but not with the same vigor. And frankly, not with the same vigor that we saw earlier in the year, that we saw over Brexit, for example, and other times when maybe these problems have been similar but different, but maybe we're learning more about these as we go along, and therefore the reaction doesn't need to be as big.
In 10 years' time, every once in a while, we see problems in Greece, we see problems in Italy, we see problems in Portugal. Is this ho-hum? Do we think the Eurozone is going to kick their issues down the road like they have in the past? It's not going to amount to anything enormous?
So that's what they've done so far, and that's
Right.
frankly what they're very good at. And I think that's the one thing that you can take away from this move, at least that we've seen so far in the euro, and the move that I believe we're going to see in the euro is that, yes, it's probably a kicketh, if you will, of the can down the road. And
Understood.
frankly, again, these problems may not be that big of a deal as originally thought.
Now, before we dive into our trade discussion, I'd like to point out with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices prices and movements will vary. Right now, when we price this out, the euro currency is trading at 1.1590. Scott.
Yes, Jim. So we talked about maybe the problems not being so bad, right? Maybe there's not as much to worry about here. So
Well, markets overreact.
Yes, I think so. And looking at that and looking at how options prices are out there these days, I was looking at some very interesting levels and some very interesting pricing that I am willing to share with you right now. Specifically, week 3, October, 6E euro call spread, Jim. 1.16 to 1.17 call spread you can put on. This has the underlying, as you mentioned, at 1.159. It risks of $512 to put on to make a potential 737.50, okay, 50 cents. And here's the thing. The reason that I put that on is because if you look at the charts, you see the markets rally, you see the 60 euro rally in August all the way up to the highs that we saw in September and this recent reaction of what's going on in Italy. It's retraced 50% of that move from that run up. And to me, I think that's overdone, and we're going to see this thing belly up again towards the north.
So basically, it's 10 ticks below the lower strike. So let's call it at the money when you're talking about in terms of 3 weeks. So that's why you're paying 41 ticks out of a potential 100 ticks wide. So you're paying a decent amount of money, but the probability of it happening is much greater than a punt, let's say, that's out a bunch of space.
And
right?
we've already seen a ton of that selling pressure that's knocked it down to where it is anyway, where you've got kind of that bottom level in, and then you just need to capture the top
Understood.
side.
Now, I'm looking at it differently. I thought when the euro broke, and particularly the fact that we've been raising rates, so I've been looking at put spreads. I'm looking at buying the week 3 October, the same expiration as yours, the 1.15.5, 1.14.5 put spread for 27 ticks. Expires October 19th. Underlying is 1.1590. It risks 337 to make 912. It's the same distance wide as yours. It's further away, so that explains the cheaper price. Thoughts?
I don't agree with the direction, but I do like the risk reward and the expression here because of the fact that, listen, it does feel like we're going to get some volatility out of the euro. I mean, let's face it, this probably euro situation is not near done, so therefore there's going to be some volatility in the currency, and this is one way to take advantage of it.
When you look at the move in the euro that happened, the lower move over the last few days, does it even come into your head that we are raising rates and the dollar should be stronger because of that too, or is this all about Italy?
It kind of does matter what the Fed's doing, but remember, the Fed's been on this track, and it's been on this telegraph track now, Jim, for most of the year, at least as far as we're concerned, as we've been saying on the show. So to me, maybe it's more the Italian story than really rising rates in the U.S.
I agree with you on that. Thanks for joining us on Market Movers. I'm Jim Urio, where we're hoping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.